Hey guys, Ken Boyd with the Accounting Accidentally website, where you can find over 300 blog posts and 400 of my YouTube videos. And also wanted to let you know about our Patreon channel, where you can get subscriber-only videos and blog content. So what I'd like to talk about today is, I'm going to go full screen here, view slideshow. We're going to talk about the Gap, the clothing store, and we're going to explain these metrics. So EBIT is defined as earnings before interest and taxes, and EBIT margin, which is less used as a term, divides EBIT by sales or net income. So what it's telling you is, for every dollar of sales or net income, every dollar of sales, how much are you earning? Now, you'll note that interest and taxes, the I and the T, are added back to the earnings number. EBIT margin is also defined as operating margin. Profit margin, profit divided by sales, or the dollar amount of profit you create for each dollar. Pretty basic. Sales mix is the percentage of company sales that a particular product line generates. And we're going to see how the Gap is changing its sales mix. And finally, dividend yield, the dividend amount in terms of dollars divided by the stock price. So as a percentage, what percentage of the stock price are you getting back as a dividend is really what dividend yield means. So let's talk about the Gap. This is from an investor meeting, October 2020. So you know the name Gap. Old Navy, Gap, Banana Republic, Athleta, huge sales. You can see billions and billions of dollars of sales. So you know this brand, but they're struggling like a lot of retailers are struggling with the pandemic. So what are they doing about it? Well, $16 billion in revenue. They were a financially strong company going into the pandemic, strong and consistent cash flows. There's their 5-year average, $1.5 billion a year. And as is important with shareholders, they're returning cash to shareholders in the form of dividends and stock buybacks, share repurchases. So they were in good shape going in. So what are they going to do? Well, if you look at this formula, which I thought was interesting, they're trying to grow sales low, mid, single digits annually, so slow growth in sales, not rapid. It's a fairly mature industry. And they're going to try to expand that earnings before interest and taxes margin number. In other words, that operating margin number by 10%, 2023. What that's going to result in, there's that equal sign, operating cash flows around 10% of sales, and they're going to return more cash to shareholders. That's the goal. Now, here's where we get to sales mix. It says on the left side, 2019, 55% of sales are Old Navy and Athleta. 2023 estimated 70% of sales to Old Navy and Athleta, because they think that's where the growth is, and more importantly, where the profit is. So it says underneath the main heading, a shift toward higher growth, higher profit brands. This is the change of sales mix. The mix of your products is going to increase in Gap's from Old Navy and Athletica sales. They want more of that. They're also going to cut costs, not surprisingly, like a lot of retailers. They're going to close physical stores. They see trends that people are not going to buy in physical brick and mortar stores like they used to. So Gap and Banana Republic, the two slower selling brands in particular, they're going to start closing stores, get rid of those high fixed costs, and shift to more of an e-commerce model. So what's the result out of all that? Well, they want to increase cash flow, cash inflows. Many large companies, CFOs, look at cash flow as the metric. There's the dividend yield. You can see it's pretty high comparatively for 2019, 5.6%. On average is pretty high. They want to continue to pay a higher dividend, a higher share of earnings to shareholders, and increase the dividend yield, which is dividend divided by stock price. CapEx, bottom left, capital expenditures. That's the amount of money they spend to replace or purchase new long-lived assets. If you have fewer brick and mortar stores, that will help reduce the CapEx number. And finally, bottom right, share repurchases and cash dividends. That is how they're going to get money back in the hands of shareholders. So that's what's going on with the Gap. And I'm going to click here to end the show and finish up with, again, if you'd like to get subscriber-only content, you will find it here on my Patreon page. Here's the address at the top. You can also click on the Get It Now button on my homepage to get subscriber-only both blog posts and video content. Thanks for watching, and we'll see you next time.